Well, good afternoon. Time to have a look at the markets. And as we usually do, we start off looking at the Asian picture and declines in Japanese markets, as well as the fall we saw in China's tech shares helped drag the Asian markets a little bit lower. Hong Kong's Hang Seng Index dropping 0.2%. Mainland Chinese markets also in negative territory, closing lower. And it's the idea around, the slowing business activity as well as mixed earnings last week Friday that helped, in this particular case, facilitated in having U.S. markets closing in the red on Friday. All eyes this week shift to the U.S. Federal Reserve as they announce their interest rate decision, as well as Q2 GDP figures from the U.S. Locally, we had a fashion retailer, Mr. Price, reporting that they have managed to gain some market share in their apparel business in the first quarter of the 2023 financial year. We also had interim numbers coming out of Anglo-American Platinum showing a 42% drop in headline earnings per share on the back of slower sales and declining prices. But to talk to us about the latest when it comes to the markets, as well as throw forward in terms of what we can expect, we are joined by Michael Traherne from Vestec Asset Management. Michael, thank you so much for your time. I mean, you look at what's going on in the Asian side, bit of a mixed bag. Michael, on that sentiment for the JSE, what's driving that right now?
Yeah, afternoon, Anastasia. I think a bit of an internet glitch there. As you said, the big thing or the big theme for the week will be US Federal Reserve and US second quarter numbers from major companies, your big tech stocks, Apple, Microsoft, Amazon and the likes. All reporting this week, and that will drive sentiment for the next couple of weeks. I do think the biggest point that will be moving the markets, though, will be what the Fed does this week and then the commentary around that interest rate hike.
Given the earnings that we've seen so far from a U.S. point of view, what do you make of earnings season thus far? And I suppose, what are some of your takeaways?
Yeah, so earnings have been broadly in line with the expectation. Generally, what happens is you go into earnings season, the market's got a number penciled in of what they expect to happen, and deep down, people expect companies to beat the expected number. And that's just how it works, is management look good when they do better than expected, and that's sort of the general flow of the market. Coming into this earnings season, though, most people have been apprehensive that the number that's been penciled in for profits might actually be a miss, and that companies will revise their guidance lower or cancel their guidance. And effectively what happens then is when companies miss, their share prices are very, very heavily impacted. So far we've seen broadly in line, but it's still early days. The major companies that really count, they're coming in the next 2 weeks.
Yeah, and we'll get to those in a bit. But let's go back to that discussion around the federal rate and the expectations for this week. I mean, a week or so ago, we were trying to digest what a full percentage point increase would mean. And now it's whether 75 basis points or not. What is the market expecting when it comes to this week's FOMC minutes, given what you're seeing with the dollar index, etc.?
Yeah, it's very interesting to see how expectations can change. I think it was 2 or 3 months ago, the market was selling off on the expectation of a 50 basis point hike. Then 75 was mentioned and it sold off again. Then 1 percentage point increase was mentioned and it sold off again. And then last week, the market now seems to be pricing in a 75 basis point again, and that's why we've had a strong week. And that's just, it shows you how expectations change and then that how it drives the market. So as it stands at the moment, 75 basis points seems to be the number that the market's pricing in, and that seems to be what the federal governors have been saying in the lead up to the meeting. But we need to wait and see exactly what will happen, and then, as you say, more importantly, the FOMC minutes about what was discussed at the meeting and the general sentiment around future rate hikes.
I look at yields right now and I wonder whether I'm misreading them. Are they at war with themselves? I can't tell. What's your assumption about whether we've seen a peak in yields?
Probably it's a bit more pain for yield. I think what matters is depending the time frame that you're on. So short-term yields versus long-term yields. On the short end of the yield curve, you see that we're going to see a lot more rate hikes on the short term. Long term, though, the market's pricing in interest rates peaking towards the middle of next year and then actually even starting to drop again. That's probably a bit too optimistic or pessimistic on both sides. I think central bankers like to keep things smooth. So my assumption is that we'll see slower interest rate hikes, but then a lot fewer interest rate drops in the future and try to keep it stable.
This is the point where I'd like you to let us in here as the viewers. When you're sitting with the team at Vestec, whether it's you, Byron, Bright, and Paul, what's the Vestec mid-year review and scenario analysis look like, given the uncertainties we see? We still have an ongoing war in the background. What are you saying to each other and to clients?
Yeah, I think that's where your time frame and expectations are very important. Vestec, we've been very clear with clients that money invested with us is a 3, 5, 10-year investment time horizon. These blips that we've seen in 2022, they're normal. They happen once a decade. This one's slightly prolonged, but these are buying opportunities. And if you've got the right or the correct companies, with hindsight now will probably be a good time to be buying, is our view. It's the big thing that we do is hold clients' hands and say this will be okay and this too shall pass. The expectation going forward is that we see a peaking in inflation, and that sort of seems to be coming through in the next month or two. And if that's the case, then we expect the market to rally into the end of the year and hopefully get close to break even, although we're probably not expecting a break even year. It's worth noting the last time the market had this bad of a start, it actually broke even for the year. So if that could happen, that would be great.
You mentioned in your earlier response that the earnings that really count are going to, take place over this week and the next week. And this week, we've got the likes of Microsoft, Facebook, Amazon, as well as Apple. What will you be looking for when these companies publish their earnings?
The main thing that you're looking at is how they compared against last year this time and the previous quarter. What is their guidance going forward? We've already seen some of the other large multinationals that have reported last week talk about how a strong US dollar has actually been bad for them. You'll probably find something similar with these large tech stocks given all the countries that they operate in. And the question then is how bad is the impact from a strong dollar? And then what's happening on the hiring front, what's happening on the future pipeline. For long-term share price appreciation, you need to be looking at what's management forecasting for a year, for 1 to 2 years from now.
Where are you seeing opportunities after what some might describe, I suppose, call it 6 months of turmoil?
I think the market in general is looking on the cheap side where we've come from. It's the market's highlighted that companies with strong balance sheets, with lots of cash on the books, is where you want to be long term. And I think those companies have been sold off more than should be. They've been lumped in the same basket as companies with more fragile operating business plans. And I think that's where you want to be aiming at. I think it comes down to, at the end of the day, whatever company you're investing in, you need to have done your homework, understand your assumptions, and then understand what your forecasts are. If you know what the assumptions around your forecasts are, you can very quickly react when those assumptions don't come true.
Last week, one of the conversations we were having with our analysts was, if we are heading into a recession, given the fact that we've been talking about it for such a long time, what are you uncomfortable owning for clients as a portfolio manager? And some of the responses that came through, one was saying discretionary retail stocks. Others were talking about being careful around commodities around about this time. What are you uncomfortable owning?
Yes, I think that comes back to what are your time frames. If you're a portfolio manager that has to report quarterly, to your clients and to big pension funds, then you're a lot more sensitive to the quarter-on-quarter changes in share prices. Our strategy is to pick the companies in the sectors that are growing the quickest over the next decade. And if you pick the leaders in fast-growing industries, it's going to be a turbulent ride, but in 10 years' time, you'll be smiling, and that's where we're aiming at. So we're not into short-term cyclical companies. Commodities, particularly the likes of your gold counters, they're very, very cyclical. And we'll be the first to admit that we're very bad at timing the cycles. And it's easier to pick long-term trends than to try call a short-term emotional changes in the market. So I think it's stick to your knitting, know your strategy, and make sure that your clients and customers are happy with that strategy.
Outside of US earnings this week, any other events you're going to be paying attention to?
No, not really. I think it's hard to beat the big tech stocks and the FOMC meeting in 1 week. That's going to keep us plenty busy.
All right, let's leave it there. Thank you so much for your time. That is Michael Traherne from Vestec Asset Management, giving us his perspective when it comes to the markets, as well as highlighting some of the key earnings that are going to be coming out. As he mentioned, it's both this week and next week, the earnings that really matter. And of course, that FOMC meeting on Wednesday, which we will be unpacking for you in greater detail. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.